We have Sachin Shah, who is joining us now from Emkay Global. Sachin, good afternoon. While market actually got shaken out, at least the levered part of the market, not everybody, I would say, and the healthy correction has played out in the small cap, mid caps. Have you started nibbling or biting back into some of your favorite names with that surplus cash which you had on the table?
Yes, absolutely, Ajay. You're on dot. So we have started once again reinvesting in some of the names that we like, wherever we have seen some decent amount of price corrections, and of course we are also done with the latest earnings season. So wherever we have got confidence in terms of the business outlook, wherever we believe that over the next 2 3 years the growth trajectory is going to be fairly strong, and the valuations are now, at least in some of the mid and the small cap names, we are seeing at least a 15-20% plus kind of correction. So we believe this is a good entry point, and we plan to deploy our cash at this point in time.
One end of the market has got mighty excited last few days is the specialty chemical space, be it Tata Chemical, Rallis, some others as well. I want to understand, do you think the worst is over for specialty chemical? I'm only talking about the high margin complex chemical companies, not the commodity chemicals. Do you think it's risk reward is favorable to start nibbling in there?
Yeah, so Ajay, the way we look at it is that whether it is the specialty chemicals or some of these businesses in the CDMO space, the CRAM space, even catering to the pharma space and some of the agro side of the businesses, we believe that this is a secular story for the next 3 to 4 years. And Indian companies have the right to win for these global customers because they have the domain expertise. They have demonstrated that they can actually deliver scale, and probably the global customers trust the Indian promoters or the Indian corporates relatively far better as far as their IPR are concerned, intellectual property rights, at least compared to the counterparts in the China. So I think that edge that the Indian companies have demonstrated over the last 3 4 years, I think we are in for some very large scale order book and some very large scale manufacturing that's going to happen in the next 3 to 5 years in this country. So yes, the business is going to grow. But of course, as you know, that in the probably not the last 6 months, 8 months, but if you see 2 3 years before that, the valuations of some of these businesses had also run up quite a bit. But in the last, I would say 12 months or so, or at least last 6 to 12 months, a lot of these companies, we have seen decent amount of both time value correction, I would say. And from that perspective, selectively, yes, there are opportunities now in that space.
Okay, incrementally from here on, if I were to ask you, even the beaten down PSUs have corrected anywhere 20, 30, 40% depending on the name you're. Which is your favorite end of the PSUs, which you will be eager buyer on declines?
So, Ajay, frankly, at this point in time, in none of the portfolios or funds that I manage, we have any exposure to PSUs at this point in time. So difficult for me to comment, but yes, we are evaluating some of the businesses, whether it is in the defense space or in the railway space, where we believe there is a very, again, high growth trajectory, because the order books, again, over there are fairly strong, and there is a good possibility of they continuing to deliver very strong numbers over the next 3 to 4 years. But still, some time away before we make our final decisions.
Okay, another area of the market, everybody loves to bash them. But then if you look at what the M&A in financial services has been in the last 6 months, it's the banks which are buying out the NBFCs. But NBFCs get the beating. And of course, the glare from the regulator whenever they go out of deviate from their processes. Would you be a buyer in some of the beaten down NBFCs?
Structurally, if you see, Ajay, one thing very important that has happened over the last, I would say, 12 to 18 months. The weights of the overall BFSI sector in some of these large indices, whether it is Nifty or even if you take Nifty 500, has actually secularly been coming down, right? So what used to be probably about 40 odd percent is now in the range of about 30 odd percent. So that's a significant drop over there. That's point number one. Point number two, and because it was 40%, most of the portfolios were fairly, I would say, overweight in this sector with almost 35-40% kind of exposure already in the BFSI space. And now that the index weight is somewhere just about 30 odd percent, frankly, we don't have too much of room now at this point in time to add to the financial services at this point in time. Although I would like to also clarify here that a large part of our exposure is only into private sector banking, and we like to stick to them.
Which business of the Tata Groups which you really admire, Sachin? There is a very large IT company. There's an EV company, CV EV company where restructuring has been announced. There's a power company which is transforming into a renewable side. Then there is chemicals, hotels. Which are the few businesses in the Tata Group which you really like? They appear to be getting re-rated because there is talk that the Tata Sons, the parent, would be going for a listing. But we are not talking about that. We are talking about the businesses which you like, not the stocks.
So Ajay, Tata as a as a group itself is the most admirable group, I would say, at least in India. And I think not only the way they have grown, but I think in terms of their value systems, in terms of the way they have built a franchisee over the generations, and the kind of the trust that they have earned, because trust is something that you cannot buy, is something that you have to earn, and they have earned it over so many years. But one business which stands out across everything, although we are not investors there because we always love that business, but we find the valuations even too expensive. But is the business in the retail side, because that is one sector which is a very, very difficult sector. And not too many companies have been successful over there. But when it comes to West Side, when it comes to Zudio, when it comes to Zara, I think across the board they have brilliantly delivered, and against all the headwinds in the sector. I mean, when you see some of their peers, most of them have not been able to perform over the last 4, 5, 7 years, and they have just done brilliant. So I think, and they have created that amazing franchisee with the consumers, whether it is Westside, Zudio, Zara. So I think, and the kind of the efficiency that they have got. So I'm in absolutely awe of that management, that business. And I feel very sad that I don't own that business at this point in time. Of course, the another very interesting thing which has already played out over the last 10, 15 years is again on the retail side, which is Titan, which is the Tanishq brand. I think again that brand I have personally witnessed that brand how over the last 15, 20 years from the unorganized to organized. It's a paradigm shift that they created in the consumer's mindset, going from their household dwellers to a branded play like Tanishq, and again fantastic execution.
What are your thoughts on the commentary made by RBI Governor just yesterday on our channel that we could actually be clocking growth close to 8% this year and definitely 7% or thereabout higher than that next year? Do you think it's in the price, and what does it really mean for corporate earnings and the growth?
So Ajay, most important thing is that the corporate earnings, I think the most conservative estimates will be that for the next 2 years, we will grow at a nifty level. If you talk about it, we'll probably grow at about 15% compounded for the next 2 years. That will be the most conservative ones. Optimistic may say about 18-20%. We'll see how it plays out over a period of time. Right. I think the most important thing when it comes to the domestic GDP growth, I think, is the manufacturing sector that has kicked in. Right. We are seeing some amazing amount of the capex that from the private sector side that's happening, and some of the very, very large capex in the emerging sectors, whether it is your the solar cells, whether it is electric batteries, or whether it is your in the renewable energy space, right? So all of these places we are seeing some significant amount of capex that is getting lined up and is already happening at the ground level. The other very big enabler is the PLI side, right? Where already I think more than 1 lakh crores is already invested on the ground, and another at least 2.5 lakhs in the next couple of years is going to happen over there, right? And there are at least some of the large industries like your steel, cement, all of them are probably today running at very high capacity utilizations. So, and the large players within that industries now have very, very strong balance sheets, very, very, I would say, high generating cash flow machines at this point in time. So, they all of them are actually going to reinvest significant or already reinvesting significant amount of money. So, I think the manufacturing sector is probably going to actually, or the overall private sector capex is actually going to drive this GDP growth for the next 2 3 years.